So are you tired of being held hostage? It's the only word that comes to mind by the traditional car buying process. Like, how many of you have bought a car recently? It's kind of mundane, right? The car dealership experience, the used car dealers. What if I flip the switch? Have you ever heard of the infinite banking concept? You ever heard of how it could be used to buy cars in a smarter way? Well, that's the biggest thing I want to do in this video. I want to use this video to give you all that I've done with buying cars, but I want to wrap it up with a pretty little bow, and I want to show you how you need to start buying cars. Because doing it this way will allow you to get all the money back for every single car that you will ever buy, drive, and own. Oh yeah, that's exactly what this is gonna do. This way that we're gonna show you how to buy cars is a way that's gonna build your wealth. It's not gonna steal your wealth. When you buy a car like this thing, if you do it the traditional ways, you're not gonna really come out ahead on that in most cases. The way I'm gonna show you how to do it is always gonna have you coming out ahead because, hey, if you know how to get all the money back for every car you buy, drive, and own, well, that's where it starts. But you see, it gets better and better the longer you do this. You'll never overpay for a car. And even if you do overpay for the car, it won't matter because all the money comes back to you. So let's dive in. What is the infinite banking concept first? That's the first thing we need to kind of understand. The infinite banking concept is very simply put, it's a process. It's a process of you taking back the banking functions in your life. It's exactly what it is. And once you understand banking and you understand how to take back the banking functions, you then are much further along. But I don't think anyone knows what I mean by that right now, right? Everybody got that? Everybody understand that? No? All right, well, let me break it down for you. So let's get into the infinite banking concept. Again, it's a process. So to understand the process, we have to understand banking. And I'm going to teach you that in a second, but specific to car buying. So let's just start with this. How do you buy cars? There's 4 ways you can buy a car. What are those 4 ways? First way you can buy a car is you can pay cash for the car, right? You save up the money, you capitalize your bank account, and then you go and pay cash for the car. Maybe you have all done that. Maybe you haven't. Doesn't matter. That's the first way. The second way you can buy a car is you can finance the car. You go to the dealer or you go to the car place and you go to their finance company or you use a bank and the bank comes up with a loan where you're going to make monthly payments of principal and interest back to the bank. In exchange, they give you the money to buy the car. How many of you have done that? That's the second way. The third way you can buy a car, it's not really buying it, but you can lease a car, is where you make monthly payments to a finance company still for the right to drive the car for a specified period of time. And then when that time's over, you just hand the car back. And there's all sorts of rules. They give you X amount of miles you can do. You got to keep the maintenance up and all that. But what is the fourth way you can buy a car? You could steal a car. I mean, I don't recommend that, but some people do that. So those are the only 4 ways you can buy a car. And the fourth way is one we're just going to forget about. So cash, finance, or lease. Well, let's focus on number 1 and number 2, because I think leasing is a terrible way to do a car because you're never getting anything. You don't ever own the car and you're just giving money away. Every month, your money's just going to them for the right to drive the car. And for some of you, you're like, oh, it's a tax write-off. Well, I can show you how to buy the car cash and then lease the car to your company and get all the same things. But we're not going to go there today. So let's start with the first thing we need to understand. If we're going to pay cash for a car, how would we save that money up? Well, you take your paycheck and you take a certain percentage and you save that. Duh, that's what you're already doing, right? You take your income and then you save your income into a bank, whatever bank that is. And then when you save up enough money, you can go buy the car. But what if we just changed one thing? Because how many of you really love the interest rate the bank is paying you on your money? None of you do, right? So in order for this to work, in order for us to be able to buy cars my way, you're going to have to change one thing. And you're going to have to change where that money goes first. See, we're going to still save the same amount of money, but we're going to put it into a different kind of account. We're going to put it into a machine. Now, let me frame up what this machine does. So this machine, which we're going to call it your privatized bank, because it is your private bank, your private bank is going to pay you a guaranteed interest rate between 3 and 25% by the numbers today. So that's what you're going to get. 3, let's just call it, we'll just round it down. We'll go right in the middle. It's between 2, depending on the company that we do, it's going to be between 2 and 3.25%. So for today, let's just use 3% interest, guaranteed. Okay? And that interest is guaranteed. I just want to be clear about that. Then, the place where you're going to put your money, this machine, is also going to pay you a dividend every year. Okay, so every year, it's not guaranteed like the interest rate, but every year, and they have for hundreds of years, they're going to pay you a dividend on your money. So then, if we combine the interest that you're earning with the dividend you're earning, I can tell you right now that your private bank will pay you between 5 and 6% on your money. Not bad. Considering traditional banks pay about 1% or less, you're going to get 5 to 6%. Now we're really talking. But let's just make this simple and let's just kind of shoot it right in the middle. We're going to call it 5.5%. But your private bank is going to do a couple other things that a traditional bank cannot do. Your bank is going to allow your money that's earning this interest rate and dividend to grow tax-free. Oh yeah, that's right. So any interest you earn inside your private bank, it's going to earn it tax-free. And that money is going to be private, just like the name says. So you don't have to report this at the end of the year to anybody. Nobody even needs to know your money's in this. Not only is it private, it's protected. So we're going to make sure that this bank is 100% protected. Because if you get in a car accident, somebody slips and falls on one of your property, something happens and you get sued, we don't want somebody coming in and taking all the money in your private bank, right? So we got to make sure that that money's protected against judgments and liens. And what else your private bank's going to do is your private bank is going to provide a legacy for your loved ones. That's right. If something happens to you, your loved ones, not only are they going to be able to run the private bank, but they're also going to get a big payout. And that payout's going to be multiplied. Let's just say 10x. Okay, it could be even more than that, but we're just going to use 10x. So this is what your private bank's going to look like. It's going to pay you about 5.5% with dividend. Okay, it's going to be tax-free growth. It's going to be private. It's going to be protected against judgments and liens, and it's going to provide a legacy someday when you graduate and go on to heaven. That all sounds pretty cool, right? So if we just change where your money goes first, and I'm going to change this from income, this is going to be the amount that you're saving. So this is going to be the money that you save, and we're going to put it into your private bank that gives you all that. Now, you're probably all saying, well, yeah, Chris, but what is this? How come I've never heard about this private bank? You have. You've heard about it your whole life. You've just never understood how to use it. Because you know what your private bank is? This machine that does all that stuff? Let me tell you. It is a whole life insurance policy. Okay, but a whole life insurance policy that's issued from a mutually owned insurance company that pays dividends. And then I'm going to go one step further. It's not just a regular whole life. It's specially designed and engineered to do this. So we're just going to say it's specially designed and engineered to use for buying cars or doing anything you want. But we're specifically talking about cars. All right, so now that we know what this private bank is and we know what it gives you, I want to hit the elephant in the room. You're thinking a whole life, oh, I've heard about those. They're terrible places to put your money. They're expensive. They have high fees. The advisor or the agent gets all the commissions. Okay, you missed one thing. All you heard me say was whole life, and then everything else was just, you didn't even hear anything else, did you? I said specially designed and engineered, which means we build these whole life policies to do a specific task. They are not the same whole life that your broke-ass brother-in-law sells you. These are definitely different. So number one, the thing that makes this specially designed and engineered whole life different is the way the cash value is accessible. We designed the policies for maximum cash value, okay? Because that's what you want. That's what you need. If we're going to build a banking system, a private bank, you need access to the cash value. So whatever money we put into the policy, remember we're saving up to buy a car, that cash value, you're going to have access to that money. How much? It depends on the design, but between 60 and as much as 90%, depending on how we design the policy, depending on your age. There's a lot of different factors, but this is going to be the first year. So if we put $10,000 in, at the end of the first year, you should have roughly, depending on the design, 60 to 90%. But you have access to the money immediately in the first 30 days. So we can put money in, like somebody literally could go in and they could put $30,000 into the policy all up front. And then they could put $500 a month in after that. And that $30,000, they're going to have access to roughly about 90% of that money in the first 30 days. But that's not what I'm trying to tell you to do, because we're going to do a savings program. Because remember, what we want to do is buy a car. And we want to get all the money back for all the cars we ever buy, drive, and own. And all we had to do, if you remember from where I said that, is change one thing. That's it. One change is where your savings goes first. So now that we understand what the cash value is, now that we understand that we're designing it so that you have access to more cash value immediately. And how do we do that? Now, this is important to know, and I'm not going to waste a lot of time. When we design it, we put the lowest death benefit on for the highest cash value, which reduces our commissions. Remember earlier you said these are high commission products that pay the agent a bunch of commissions? Not these ones. Because if we design a policy for roughly 90% of cash value, we're cutting our commission down by roughly 90%. Get the drift? That's how it happens. We give, so you get. So let's get into it. So what we're going to do is we're going to change where our savings goes. Because if you're going to buy a car cash, you got to save the money. So we're going to change where that money goes. We're going to put it into this whole life. And then once we get enough money saved up, let's just say we save up $40,000. I don't care how you get there. You dump 20,000 in, you save the rest. Doesn't matter. We can get you there based on whatever it is you want to save for the car you want to buy. But I'm just going to say all we're going to do, and I'm going to draw a box here, is we're going to take out $30,000 because we want to buy a car for $30,000. And you're going to pay cash for the car because that's how we're going to do it. But when we take that $30,000 out, this is very important. If we started with $40,000 in the whole life's cash value and we take $30,000 out, how much money's left in your whole life? Well, you guys are doing simple math. You're like, well, you started with 40,000 minus the 30. There's 10,000 left in the whole life. Wrong. The way we design these, all 40 is still in your whole life insurance policy. So whose $30,000 did you take? Well, you took the life insurance company's. Okay. So why would the life insurance company give you $30,000 of the $40,000 you have without taking the $40,000 out of your account? This makes no sense, Chris. It makes all the sense in the world. The insurance company promised you a few things in that contract when you started this policy. They promised the guaranteed interest rate on your cash value. That was a guaranteed contractual promise. The second thing they promised is that someday when you die, there is going to be a death benefit paid out. And we all know this, right? I don't care what kind of life insurance you buy, there's a death benefit that gets paid out someday when you die. Now, because they promise to pay a death benefit when you die, the insurance company doesn't care if you use that death benefit while you're living, up to and only up to the amount of cash value that you have to collateralize it. And how the insurance company does this, if in this policy you had a $300,000 death benefit, just using a number, and we wanted $30,000, they're literally going to subtract $30,000 from your death benefit. So if you died the next day, that's going to be $270,000 that's going to be paid as a death benefit. Follow where that 30 grand came from? Then the $30,000 is going to be sent out to you, but that $30,000 is going to be a loan from the insurance company. So this $30,000 that we take, that's a loan. It's a loan against your death benefit. Now the cool thing is if you really logically think about this, the insurance company is going to pay $300,000 when you die. They just loaned you $30,000 of the $300,000 while you're living. They collateralized it with your money that's in cash value. So now you got $30,000 collateralizing that loan. And if you die now, they're just going to subtract it. Do they care if you ever pay that $30,000 back? Think about this. They promised someday when you die, they're going to pay that death benefit out. So if you take it early and you never pay it back, does the insurance company care? No. So you don't ever have to pay this loan back. Now, with the infinite banking concept, we're going to show you why you want to pay it back, but you don't have to. Because here's the other thing. The insurance company is going to charge you interest on that loan. But your money never left your account. You got $40,000 earning interest and dividends. It's compounding every single day. It's compounding every single month, every single year. So 30 or 40,000 you have in there, heck, I mean, just to keep math simple, we can make that 40-30. It doesn't matter, but every single day you have more money than you had the day before because of compound interest. And as time goes by, that 40 isn't 40 anymore. That 40 is 40 plus interest and dividends. And now that interest and dividends is compounding the next year, plus the new money you put in, your savings that you're saving. Do you see what I'm saying? Compound interest is one of the most powerful things in the financial world, period. Albert Einstein said it, and I'm always repeating myself, but he called it the eighth wonder of the world. Those that understand it, earn it. You are now earning it. Those that don't understand it, pay it. That's the old you. You used to pay compound interest. Now you know how to earn it uninterrupted while still using the money. So you got it? So the big thing that we've got to understand is between the money that you're making and the money that you're paying in interest, you're making a spread. And every year that spread goes up. Okay, so let's keep going. Now we got 30 grand in this segregated bank account. Now, what is this segregated bank account? It's just a second bank account you opened up at your local bank. Why? Because we don't want this 30 grand going into your regular checking account where it gets spent on stupid stuff. Plus, we want to keep books and records. So this right here helps you very easily keep books and records of all transactions. We know we had $30,000, which was a loan from the insurance company, come out. And then what are we going to do? We're going to use that $30,000 and we're going to go buy a car. Now, we're paying cash for the car. But you see, you got to act and treat your money the same way as you would have treated their bank's money. So if you were to finance the car, I went on and I ran a calculator. And I did it at bankrate.com. To buy a $30,000 car at 5% interest, because that's what we're doing. We're buying a $30,000 car. We're assuming that the interest rate is 5% on that car, and we're going to finance it for 5 years. Just go with me. If you were to finance the car through the dealership or through a bank, that payment on that car would be $566 a month for this car. Okay, because this is what we're doing. We're buying this car. $566 a month. I just want you to remember that. And if you really want to have some fun, I'll tell you how to do what I did with my wife. So my wife, when she was pregnant with Vivi, our daughter, I got her a push gift. She needed a new car. So we always wanted a Porsche. We went in and we're negotiating with the Porsche dealership for this Cayenne Hybrid S, which we no longer have. We sold it, but that was a sweet car. And we're going back and forth negotiating the price. And he says, well, how are you buying this? I said, well, I'm going to finance it. Now, I didn't say I'm going to finance it with your bank. I'm going to finance it with my private bank. But I didn't say that. And he says, okay, well, let's figure out what the payment is. And he started going back and forth with numbers. You guys have all done this, and women, you've probably done this too. You have them go back to the finance manager. They come back. They slide a piece of paper over with a number on it. You look at it, you're like, no, you got to do better than that. They go back to the finance manager. The salesperson sits down with a big grin, slides it over. You look at the number. You said, no, man, we're still off. Like, this is where I need to be. This is where I need to be. You slide it back. They go off to the finance manager. Salesperson comes back and says, all right, this is really the best we can do. We can't do any better than this. We've cut everything out. There's no better number. And they slide the number over to you, and you look at it, and you're like, okay, let's do it. And then the salesperson now thinks they sold the car, or they did sell the car, and they slide over all the finance paperwork. And then I pushed it back to him, and I said, we don't need this. Well, he was confused. He's like, well, what do you mean you don't need this? Well, I know you went back and forth figuring out the monthly payment that worked for us, but I said I'm financing it, but I'm financing it with my own bank. I'm not going to finance it with your bank. I just needed you to tell me what the lowest monthly payment I should make to my bank. So now I know that. Okay, so that's where this 566 comes from. So here's what we're going to do now. Okay, so now you understand how all this works. So let's clean this thing up a little bit. We took a loan from the death benefit. The loan from the death benefit is collateralized by the cash value in your policy, of which you have access to that cash value immediately in the first 30 days after you make a deposit. So we take that money, we put it in this segregated bank account. Why? So we can track the books and records. And the reason we're doing this is so that our money, the 40,000 or 30,000, whatever number you want to use, never stops earning compound interest. And as that money grows, your spread between what they pay you and what they charge you for the loan goes up. Follow? We're not done yet. Now, this is the hard part for some people. If you want to get all the money back for every car you ever buy, drive, and own, it doesn't stop here. You see, you got to treat your money the same way you treat the bank's money. So follow with me. We figured out if you finance this through the bank, it was going to be $566 a month. Great. But then you're thinking, but I paid cash for the car. You did, but let me ask you this. If you made a monthly payment of $566. If you paid this back to your bank every single month, $566, and then we put it back in the policy as a loan repayment, okay? That's what we're doing. The money's gonna go into the segregated account, so we have records. We took 30, we're paying $566 a month back for 5 years, and then we're gonna have that repay the loan every month. First off, you are reducing the loan amount, which means you're reducing the amount of interest you're gonna pay the insurance company, but here's what you're doing. This over here, okay, this $30,000 loan at 5%, that's principal and interest. So every single month, that $566, right now, $125 by bankrate.com is interest. So out of this, $125 a month is interest. That's 5%. So now you're paying yourself back with principal and interest. And all the money, the cool part is all the money that you're paying back to your policy to repay that loan is available to you the next day when that check clears. Let me be clear. You're making $566 payments, but you're paying them back to your bank, which means your bank now has $566 more every month you do that, which means $566 could then be sent back out to work. You could just send that money right back out, pay down credit cards, pay off college loans, pay off that boat loan, fund a vacation, build a house, buy a house, invest in real estate. Do you understand what I'm saying? There's nothing wrong with paying your bank back. I know it seems foreign because you saved the money to pay cash for the car, but now I want you to get all the money back for the car. And if you do this, you will get all the money back for the car, plus you will make interest, plus you will have made a spread. And every car you buy, when that loan term is paid off, the car is sitting in your driveway, bought and paid for. But all the money for the car is in your account. So when you buy the car the next time, you're actually compounding on an even higher amount. So the next car gets better and the next one better. I've done 6 cars this way. And for every dollar I put into my policy that I use to buy a car, I get about $2.60 back. You did hear me correct. Listen, folks, to get your banking system to work the way I just described, all you need to do is treat your money the same way you treat the bank's money. When you take money from your private bank, this is your bank. Don't steal from your bank. And that money goes out to work for you. I don't care what it is. In this case, a car, to buy a car. Never steal from your bank. You would never steal from your business. And if you owned a bank, why would you steal from your bank? The $566, it's your money. It's literally forced savings, but it is a necessary piece of this process. And just so you all know, this process is called IBC, Infinite Banking Concept. This is the process I just showed you. If you like this video, you're going to love this next one because it's going to tell you the whole system on how infinite banking works. So check this video out right here. It's called BYO Bank. You will love it, and it will really close any gaps and put some numbers behind what we just did. Thanks for joining me today. Don't forget to subscribe to this channel. Click the little alerts button so that you're notified every time I do a new video. We'll see you next time. Happy hunting for your next car.